This is Macro Horizons, episode 322, Power of the Pause, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of May 5th. With Good Friday a fading memory, and Memorial Day still too far off on the horizon, we're looking at London with envy for its Monday, May Day market holiday. Well, at least the forecast calls for rain. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just passed, most of the economic data surprised on the downside. We had a weaker than expected JOLTS report. GDP came in slightly below estimates. ADP printed on the downside. Even initial jobless claims aired on the high side, suggesting a marginal change in sentiment in the labor market. However, Friday's release of non-farm payrolls came in notably stronger than anticipated. We saw headline payrolls increase by 177,000 jobs. That's on top of March's revised 185,000 print and well above the 138,000 consensus. In fact, given the apprehension in the market ahead of the payrolls release, one could argue that the market was biased for something in the 110 to 120 range. And so the fact that the actual change came in up 177,000 led to a reasonably sharp sell-off in the Treasury market. That being said, 10-year yields remain in a familiar range, and we don't think that the details within the payrolls report are sufficient to drive a macro rethink. Instead, we have the unemployment rate at 4.2%, and average hourly earnings aired on the lower side, printing at just 0.2 on a monthly basis. That was compared to the 0.3 prior and the 0.3 anticipated. As a result, the year-over-year change in nominal wages remains at 3.9%. That means that wages are not back to the pandemic trend, but certainly heading in that direction. Other details from the payrolls report include that the unrounded unemployment rate was 4.187 versus 4.152, so a solid 4.2, nothing particularly surprising there. We also learned that the net revisions for the last 2 months brought payrolls growth down 58,000 versus the prior revisions bringing payrolls down by 48,000. Even the household survey showed a solid gain at 436,000 compared to the 201 prior print. Overall, the takeaway from the economic data in the week just passed was that while we're starting to see some indications of weakness, the continued momentum on the labor front is encouraging, if nothing else, and is certainly consistent with our baseline assumption that the Fed will remain on hold at the May and the June meeting, leaving the first potential or live meeting July, but we still think that all else being equal, the Fed will bide its time and not deliver the first 25 basis point rate cut of this year until September. And as a note on the slight decline in real GDP during Q1, it was attributable to a drag from net exports as firms increased imports ahead of the new tariff regime. This triggers the question of whether or not that will be unwound during Q2 or if the market should expect further downward pressure from net exports. The refunding announcement came in largely as expected, $58 billion 3 years, $42 billion 10 years, and $25 billion 30s. Now, it's notable that the statement itself retained the language that auction sizes will remain stable for the next several quarters, which means, in practical terms, that the next time auction sizes will increase will be sometime during 2026. There was also a discussion within the statement about increasing the size of the liquidity buybacks, and depending on how this is structured, it strikes us that this could be a stealth operation twist, because if coupon auction sizes are not increasing, then the assumption will be that it's funded via the bill market.
Well, Ian, there was a lot of takeaways from this week. We had a quarterly refunding announcement, GDP report, payrolls, ISM releases, and really, my biggest takeaway is that the Treasury market is in rally mode. We have 10-year yields that have fallen impressively from their latest peaks, as the angst surrounding a more material economic slowdown has picked up, and what had been worries about no one wanting to buy treasuries or shedding dollar assets has now been replaced by a consistent grind toward lower yields, which we'll argue has left the market with a bit of a long bias heading into next week's FOMC meeting, where we won't get a dot plot, but we will hear from Powell around how the developments of the last 6 weeks has influenced the Fed's thinking from here.
And I do think that it's notable that all the messaging that we've received from monetary policymakers, and as we picked up from client conversations, is that the last 6 weeks have done nothing but increase the overall level of uncertainty in the outlook. Now, while this hasn't translated into a complete pause for activity, it has translated into an increase in apprehension about what the next several quarters will bring. Q1 showed a 0.3% decline in real GDP. However, that was primarily a spike in imports as firms sought to get ahead of the new tariff regime. The question then becomes whether or not that's reversed over the course of the next 2 quarters. Q1's GDP profile did show strong consumer demand, which in the medium term is a net positive for the trajectory of growth. All of this is occurring with the backdrop of the administration's efforts to redefine the global trade balance, and frankly, the price action suggests that perhaps investors have become accustomed to the back-and-forth headlines as it relates to the trade war, and at least to some extent are willing to refocus on the fundamentals, at least momentarily.
And that dynamic of trade war fatigue has certainly been apparent in the price action in treasuries, as the law of diminishing relevance has applied to each subsequent headline around the potential for a deal or comments from Bessent or Lutnick, as the consensus is building that while maybe a productive discussion between the U.S. and China is a little bit further off, progress on conversations between the U.S. and Europe, places like Japan and South Korea, continue apace, and at this point we'll argue the consensus is that at some point in the next several weeks or next month that we'll see some progress made in terms of tariff reduction. After all, remember what Bessent said on Liberation Day, which was that the announcements at the beginning of April represented the most severe tariffs we'll get. That ultimately proved true with the exception of China. And so now that the bar has been set in terms of the level of severity, the path forward from here seems to be a bit more optimism around a reduction of tariffs, and that should in turn moderate upward pressure on prices and presumably stabilize the outlook a bit. Now, given the volatility around the messaging out of Washington, it's far too soon to say with high conviction that we're completely out of the woods, but at this point, that seems to be the market's operating assumption.
And I do think that that's a fair assumption. We know what the downside is on the tariff front. However, what we don't know is how Trump will approach the other items on his agenda. We do know that the budget negotiations are well underway. The House is targeting mid-June for a deal. Bessent is saying the 4th of July, while the Senate says probably not until later this summer. All of this suggests that we're going to continue to have uncertainty as it relates to the debt ceiling, as well as the tax cut extension, and frankly, whether or not there'll be a positive fiscal impulse resulting from the new budget. All else being equal, we're approaching it with the assumption that there will be an incremental positive fiscal impulse, but it won't be dramatic enough to offset the negative momentum for the real economy coming from the uncertainty associated with the trade war.
And it wasn't just the trade war that drove the market this week. We did get the May refunding announcement, which, as expected, left coupon auctions unchanged for this quarter and the next several quarters, emphasis S, despite the higher-than-expected financing estimates that were released on Monday, which were largely a function of the lower-than-originally assumed cash balance resulting from the debt ceiling. Bessent is very much in keeping with his department's mantra of regular and predictable issuance, which will leave next week's refunding series the same size as February's. There was a bit of an update on the buyback front. Most immediately relevant is the cash management purchases that were bumped to $10 billion, but from a higher level, more consequential, we'll argue, was the discussion within the refunding statement itself that said the Treasury Department is evaluating ways to make the program more efficient and better at fulfilling its purpose. Now, could this be laying the groundwork for a potential increase in the buyback program going forward? Maybe, and we'll be on the lookout during the next refunding cycle in August for any question in the survey of primary dealers that is seeking to elicit feedback on just how big the program should get, should the focus of where the buying is taking place be shifted, and more details in regard to how the program might be tweaked or updated. Within the T-back minutes, and admittedly a bit in the weeds, there was also a discussion around changing 20-year settlement in order to alleviate some of the repo pressure that typically comes along with the period between 20-year auctions and when they ultimately settle at the end of the month. But that was more of a back-burner issue in comparison to the confirmation that for the next several quarters, Treasury views their auction sizes as appropriately sized to fund the deficit. Now we'll see how the efforts to continue cost-cutting and reducing the deficit continue in Washington, but at this stage, we're not expecting any increase to coupon auction sizes in the near term.
And I'll argue the fact that Bessent is actively discussing increasing the buyback size, but committing to keeping the auction sizes stable for the next several quarters implies that if more liquidity injection is needed, that it will be funded in the front end or in the bill market, which, frankly, is what we'll characterize as a stealth operation twist and should at least incrementally cap how far 10 and 30-year yields could back up in this environment. We'll also make the case that this bodes well for the refunding supply, and as the market looks to the performance of the 10 and 30-year auctions as a barometer for investor demand at current levels, we'll note that the April 10-year auction saw an 18% overseas allocation, which was the highest in 3 years. It goes without saying that the auction results will be closely followed and, frankly, could be the biggest market-moving input in the week ahead, overshadowing what we might or might not hear from Powell and the FOMC.
And let's not forget, on the softer data side, what we've learned in terms of the trajectory of consumer confidence, specifically the Conference Board measure that continues to fall to effectively the lowest levels since the pandemic. And remember, the University of Michigan metric has similarly found itself under pressure. Given the headlines surrounding the trade war, the potential and realization of higher prices resulting from tariffs, difficult discussions around expansion or hiring plans at work are likely already starting to feed through to the outlook on the household level. Now, sure, that didn't prevent the very robust personal consumption figures we saw in the first quarter's data, but remember, for the bulk of the first quarter, we had not really learned the extent of Trump's tariff plans, nor had we seen the move in equities that likely had at least some implication from a wealth effect perspective and consumers' willingness to spend. So as we make our way further into Q2, it's going to be especially important to see how some of these softer metrics begin to flow through to things like retail sales, personal spending, and the more updated sentiment measures themselves that will show either some stabilization along with equities that have kind of found their footing, or if the next leg of volatility will inspire a further pullback on the household level.
As you point out, it will be key to assess the degree to which the wealth effect is impacting decisions on the household level. We know that coming into this year, the broad perception was that consumers remained on a strong footing, and Q1's data didn't challenge that. However, in the event of another material downturn in the equity market, it wouldn't be surprising to see wholesale apprehension make its way through to consumption patterns. And it certainly wasn't lost on us that the March core PCE print of 0.0 suggested that the early reflationary impulses seen in Q1 have quickly moderated as the quarter came to an end. And while there will undoubtedly be one-time price adjustments that support core inflation over the course of the coming months, the Fed and the market appear willing to look beyond that and instead worry about the growth implications.
And especially after all of this has netted to 10-year yields far closer to the bottom of the yield range than the top of the yield range, it'll be telling to see any early concession, either on Friday or to start next week, for next week's 10 and 30-year auctions. Sure, on an outright basis, yields have moved lower and are not the most attractive they've been in recent history, but if April's reopening results were any indication, particularly in the midst of the volatility that followed Liberation Day, we don't see any real reason to expect that there won't be at least decent buying interest at the May refunding auctions for 10s and 30s. After all, to look at positioning in a lot of Treasury futures contracts, there's clearly an appetite to buy rates at these levels, given the broader concerns facing the global outlook, and a Treasury auction is a great place to get some bonds.
And like they say, there's no such thing as a bad bond, just a bad price.
Or a bad yield?
Yields are a human construct. In the week ahead, we have several potentially market-moving events on the calendar. The week starts out with ISM Services, which is expected to print slightly above 50. Moving forward into the week, there's obviously Wednesday's FOMC rate decision, and while we're not expecting any material change to the current suite of policy rates, we do anticipate that Powell's press conference will be closely followed for any indication that the FOMC is preparing to lower rates when it meets next in June. All else being equal, we anticipate that Powell will err on the side of retaining flexibility, and by this we simply mean reiterating the Fed's stance that it's still too early in the process of the trade war to have a complete understanding of how it's going to impact the real economy in the U.S., particularly in the wake of the Q1 GDP print, which, while the headline was negative, nonetheless demonstrated ongoing resilience of U.S. consumers. When considering the modest uptick in final sales to domestic purchasers, it's difficult to argue that the economy is at risk for a near-term recession. Instead, we expect that the market will continue to follow the headlines coming out of Washington, D.C. as it relates to the trade war and any forward inflation and growth implications in that regard. The week ahead also contains the refunding auctions, and because of the timing of Wednesday's FOMC announcement, the auction schedule is slightly skewed. On Monday, we have 50 billion 3-year notes, followed by 42 billion 10-year notes on Tuesday. We skip Wednesday, and then we see the 25 billion 30-year bond auction on Thursday afternoon. This series of auctions is expected to provide another important barometer for demand for U.S. Treasuries at these levels. The results of the 10-year auction will be most closely monitored for any evidence of an overseas buyer strike. Recall that April's 10-year auction saw 18% allocated to overseas buyers, which represented a 3-year high and was arguably a clear vote of confidence for Treasuries as an asset class. In light of the debate and the uncertainty regarding the prudence of the Fed's current approach to monetary policy, the market will be closely watching the array of Fed speakers currently scheduled for the week ahead. It's certainly not wasted on us that given Powell's term ends early next year, that the process of Fed speakers positioning themselves potentially for the nomination to be the new Fed chair has already begun, and as a result, we would anticipate an increasing divergence between Powell and the Fed's official messaging and the more dovishly inclined Fed speakers. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as we shift from April showers to May allergies, we cannot help but ponder if Trump would consider a sneeze tax, or at least a quota. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.